The content of today's video is for high-income professionals who did everything the right way, who built a career you're proud of, who regularly funded your 401k to save money in a tax-efficient manner, and you invested in your home and paid off your mortgage. You've made smart moves, and you're no stranger to investing. But now, you're close to retirement, which means you're facing a new stage of investing strategy. You start asking different questions and smarter questions about where to allocate your money. Questions like, what actually protects what I've built? What actually produces income I can count on? What gives me options when the market crashes? It's important to know that basic investing advice that worked for you in your 20s likely won't work for you in your 50s and 60s. Because when retirement is in sight, a down market isn't just a dip. It can be losing a decade of previously smart investment decisions. That's why in this video, I'm going to walk you through common investment options that land on the desk of high income earners like real estate, private equity, venture capital, and FOMO investments. I'll give you a clearer way to evaluate each of these for each stage of your life. Then I'll show you a different approach designed around these three outcomes: income, liquidity, and downside protection. Just to be clear, this video is not for you if you're in your 20s chasing a 100x return, just planning on riding it out no matter what, even if that means not having a return on your investments for a decade, and if you're still looking for that one shiny thing to hit it big. This is for those of you who want to protect all that you've built and grow it wisely. If you're like most high income earners, you're probably explored a few of these ways to grow your wealth beyond the basics of index funds and 401ks. You've likely looked at real estate, like rental properties, vacation homes, or syndications, private equity or venture capital, maybe through a friend's startup or a fund pitch, and what I call FOMO investments, things like Bitcoin, IPOs, meme stocks, quantum computing, and AI companies valued at 70x sales, things like that. I've invested in all of these myself, and I've seen how they really play out: the good, the bad, and the overhyped. So in the next few minutes, I'm going to walk you through each one of these, not to tell you what to avoid, but to help you think more clearly about what these investments are actually built for, what they don't give you, especially when you're nearing retirement, and how to evaluate whether they really match your needs right now. Then I'll show you what I believe is a smarter move, a more flexible way forward, one that checks all the boxes most of these can't. If you're new here, my name is Mark Anderson. I'm a construction worker turned zero DT hedge fund manager. As of today, I've sold over $100 million in zero DT option premium and have traded for over 1,000 consecutive market days. Like any hedge fund, I can't legally share my performance data in public, but I can say that my performance has been in line with the hottest names in tech, and we've done it with much less volatility and a hell of a lot less stress. I didn't come from Wall Street. I know what it's like to build something from the ground up, with your own hands, your time, and your sanity. And like many of you, I followed the smart playbook. Max out your 401k, buy rental properties in growth markets, look into private equity deals, and invest for the front of cutting edge tech. And then I hit a breaking point. It was right around COVID. I just left my job. Multiple rentals went sideways all at once. Repairs, vacancies, evictions. I learned hard lessons most people only learn once. Leverage plus illiquidity with no margin of error, not good. The smart investment portfolio nearly wiped me out. I ended up Ubering just to pay my bills and taking on credit card debt. That moment changed how I invest. I built around three non-negotiables: income I can actually spend, liquidity when I actually need it, and predefined rules to protect against risk. Flash forward to later market shocks. Instead of stress, I had cash coming in and cash on hand and a plan. In 2022, one of the worst years for the 60/40 stock bond portfolio, I had one of my most successful years yet. This year, during the 2025 tariff event in March and April, my P&L was a 45-degree line in liquid. That's the entire point of about what I'm going to walk you through. And also, I've dedicated my entire channels towards this. So let's get into some common investment options you've likely considered right now. First, let's quickly examine the traditional route: hold index funds, stay diversified, and ride the wave even if you have to wait it out for the next decade for the market to come back. This traditional route is definitely not bad. It's actually good advice. But the just buy and hold playbook was built for your 30s, not your 50s. Why? Because when you're close to your retirement, 2 bad years can erase 2 decades of progress. This is where most advisors just shrug their shoulders and say, stay the course. Over the long run, it plays out. And that's why high income earners start to shift their strategy in their 40s, 50s, and 60s. The real question is, what will actually give you what you need? Liquidity, control, and real income you can spend. Let's break them down, starting with real estate. Real estate is the first stop most advisors point to after index funds. It's safe and passive. It has tax perks, and it's a hard asset that you can actually touch. Since you're watching this, chances are you already own a home. Maybe it's even paid off. So the question becomes, should I put more into property? Here's the reality from someone who's owned multiple rentals, single family and multifamily. It's never as passive as it sounds. Even with good tenants, property management, something always breaks. Roofs, plumbing, HVAC, and with bad tenants, you're dealing with late rent, legal notices, and turnover costs that can wipe out years of cash flow. Management doesn't erase the math. You can hire a property manager, but fees, insurance, rising taxes, rising insurance, and maintenance can eat into your passive income fast. Cash flow is thin. Over long horizons, U.S. residential real estate has averaged mid-single-digit annual appreciation. But once you've subtracted maintenance costs, upkeep, transaction fees, returns are often underwhelming compared to the headache. Plus, if you finance 80% of that purchase price at a 5% interest rate, your mortgage costs wipe out that 4 to 5% annual appreciation, even after you haven't paid taxes or there's been a single broken water heater. And when you finally sell, 6% of that sales price goes to the real estate agent. That's years of gains gone in a transaction. Real estate is good for building wealth 20 years down the road, but it's terrible for producing income month to month when you have a mortgage. One thing real estate does well is provide tax benefits, but the tax benefits are not a strategy, especially with such poor returns. And also, you are paying property taxes on your real estate every single year. So in reality, it's really not as tax efficient as you think. There's also fractional ownership in syndications or REIT style platforms. These promise convenience, but you're still locked up for years and exposed to the same risk of performance tied to a single property. And now you're dependent on this startup or fintech company to manage tenants, expenses, taxes, reporting, and what happens if that platform folds. And this is where I want to introduce a concept most investors have never heard of. It's called volatility laundering. Your home's value can drop 40% in a downturn like in 2008, but because you're not getting a daily quote in red or green on your screen, you don't fear it. It's like hiding a roller coaster behind a curtain. On paper, it looks like a smooth 4% ride, but in reality, there's huge drops along the way that can wipe out a decade of gains in less than 18 months. So let's define success for a second. If your goal is cash flow that you can actually count on and liquidity when you need it and the flexibility to adapt in a downturn, real estate often fails all of those tests. It can be a decent long-term wealth preserver, but if you're looking for reliable, adaptable income, there are better tools for this job. Now, let's talk about private equity and venture capital. These used to feel like a secret handshake, the kind of deals you only get invited into when you're in the right club. Now, they're everywhere. Startup funds, friends raising money for the next big thing, private equity firms promising double-digit returns, if you're lucky enough to get in. I'm grouping them together here because even though there's a difference, the core problem is the same. You're trading your liquidity for a promise, and that promise may take years to pay off, if it even ever does. Here's the shorthand. Private equity usually invests in companies that already make money. Venture capital invests in companies that might make money someday. Both chase returns, both are high risk, high reward, and not liquid. And both have a notorious lack of transparency. The numbers they report are speculating on a business's worth, not cold hard cash flow. They can delay exits, they can dilute your ownership every time they raise a new round, and they can kick the can down the road for a year or two until they pony up to their actual losses on their balance sheets in a market downturn. And more often than not, you're getting the third or fourth bite out of the pie, after all the insiders have already taken their profits and they're selling their exit to you. You're locked up for years, praying for an exit, and if the market turns, you may get a statement saying your stake is worth X, but no way to cash that out. Paper wealth doesn't pay for your groceries. And let's talk about all of these lockups. 5, maybe 10-year commitments is common. There's no real secondary market, and there's almost zero control or visibility as an investor to what your return looks like. Now, if you happen to hit one of the big home runs, great. But here's the reality. 56% of venture capital firms have never had an IPO or a unicorn. More than that, have never even hit any kind of win that sells that they pitch on the pitch deck. That doesn't mean that there aren't good deals out there, but unless you have a serious inside access to deep due diligence capabilities, you're basically hoping it works. And hope is not a strategy, especially if you're in your 50s and 60s and want predictable returns. Ask yourself, can I afford to park my money for a decade and cross my fingers? If the answer is no, then maybe private equity or venture capital aren't what you need right now. Now, let's talk about what I call FOMO investments. These are the plays that feel exciting in the moment. Bitcoins, shitcoins, IPOs, meme stocks, whatever comes up on CNBC, Reddit, or Twitter, buzzing around all the week. They're usually framed as a once-in-a-lifetime opportunity when you have to get in now before you miss out. I get the temptation. If you spent 20 or 30 years doing the responsible thing and maxing out your 401k, investing in your home, and grinding it out in your career, there's a part of you that thinks, maybe it's finally time for my turn to take a swing at the fences. The problem with this, these aren't investments. They're lottery tickets with better branding. They thrive on hype and emotion. They usually lack fundamentals, making any money, and they have no real cash flow. And their prices are driven by speculation and sentiment, not substance. Venture capital and meme stocks have the same DMA. They're all about chasing the upside. The pitch is always 1 in 1,000 shot that turns into a massive payday. But here's what almost no one talks about, the downside. Because in most cases, there is no downside mitigation plan. You either win big or you get wiped out. Look at crypto. Multiple 80+% drawdowns in the last decade. Tesla, during the 2025 election, minus 60% from its highs. Nvidia in 2025, minus 56% drawdown during the tariff event. Cisco was the backbone of the internet in 2000. It still hasn't recovered even near its dot-com peak. Yes, you might catch an Apple in 2008 scenario, but those are rare exceptions. Here's another behind-the-scene truth. By the time most high-income earners hear about the next big thing, it's already been inflated by early investors. You're not getting in on the ground floor. You're being used as exit liquidity. So here's how I define success in this category. If you want to take a small slice of your portfolio money that you can truly afford to lose and put it in a moonshot, fine. Enjoy it, have fun. But if what you really need is predictable, repeatable income that supports your lifestyle, this is not where you find it. When you're 5, 10, 20 years from retirement, your goal isn't adrenaline, it's consistency. This is the belief shift, how most of these traditional plays actually work. And here's the mindset that I'd offer to you. All you need is 7 out of 10 base hits, not a 1 in 1,000 miracle. People who actually keep their wealth focus on protecting the downside first. If you can avoid those big drawdowns, you don't need miracle returns to win. You just need consistent base hits that stack up over time and compound with every year going forward without taking on more risk. And no, I'm not here to tell you to sell your house or cash in your retirement account or stop investing in index funds. Keep doing the smart basics. Pay down your mortgage, pay down your debt, max out your retirement account for tax efficiency, and own a slice of the index funds like the S&P or the NASDAQ. Income you can actually live on. Income that shows up year in and year out, not just someday. Then, as part of your portfolio, it needs to address a different job, one that generates cash flow, adapts to changing markets, and above all else, puts protecting the downside first. That's where the next investment option comes in. I may be a little biased, but I want to walk you through it. 0 DT options. So how do you protect the downside and generate income now while still staying flexible? The tool I use, 0 DT options. Trades that get put on at 9:30 when the market opens and expire at 4 p.m. when it comes off, that is systematic and uses rules. I know the word options can feel intimidating or sound like gambling, especially if you follow a bunch of online gurus. What I do is the opposite. Sell very specific, defined risk exchange options with a known risk and premium and risk management. No overnight exposure. Think of this as running a disciplined insurance business. Small, repeatable risk premium rather than swinging for home runs day in and day out. For this stage of your life, here's why it matters. 1, liquidity. Capital is not locked up for 5 to 10 years. You know exactly what your cash position is at the end of each day and have monthly liquidity. 2, shock handling during volatile market events. This increases option premium. Your rules can harness this instead of fear the volatility. And 3, most importantly, cash flow. Properly sized and run, this strategy is designed to generate income from selling premium that takes pressure off the rest of your portfolio. It's not about being right once. It's about being disciplined day in and day out. High trade frequency, proper sizing, setup diversification, and no overnight risk. That is the architecture. This isn't about changing and chasing the next big trade. What is done correctly is discipline and the right sizing, structure with risk management. This strategy can engineer consistency in a way that can work in tandem with the rest of your portfolio and take pressure off everything else. Risk management plus the quadrant portfolio is how I like to think of this. One of the biggest risks I see for high income earners near retirement is what I call triple long problem. You're long your job, you're long your home in an expensive area, and you're long the stock in the overall S&P or your stock options at work. Those 3 bets are all positioned in the same direction. When the market crashes, all 3 crash at once. So when the market takes a hit, it's not just your portfolio or your job. It's your paycheck, your home value, and your investments all at once. That's fine when you're 30 and you've got a decade or 2 to recover. But when you're 5, 10, or 15 years from retirement, being triple long isn't a strategy. It's a liability. What you need is income replacement, something that actually puts cash in your account without depending on those same 3 bets. The fix isn't sell everything. It's giving one slice to something different that produces cash flow in a stable way now. That's where I use the quadrant portfolio. I like to look at it at 25% of your wealth in primary residence fully paid off, 25% of your wealth in market index funds like the NASDAQ or the S&P, 25% of your wealth in fixed income instruments or a high yield savings account, avoid long-term bonds, and 25% of your capital in alternatives like 0DT. I'm not saying every retiree should put 25% of their money into 0DT. What I'm saying is that you need to think about a fraction of your wealth that produces consistent cash flow in something like 0DT. Because 0DT is traded daily, you can adapt in real time, not waiting 5 or 10 years to see what worked and having to be locked up and not getting a quote on where your money is today. You get consistent reps and immediate feedback. You're not betting on luck or timing. You're engineering a repeatable risk premium. It's the opposite of triple long. Instead of hoping all your eggs in the same basket pay off, you've built a portfolio where at least one slice is designed to thrive in turbulence and protect your assets in a risky environment. Here's the risk management breakdown. Inside that 0DT allocation, risk management isn't something we tack on at the end. It's the entire foundation of the entire suite. There are 5 key levers here that we use to keep risk in check. 1, our trade frequency. 0DT happens daily, and when you trade daily with a strict plan, you're not betting on one moment in time. You're harvesting small, repeatable risk premium. You're the casino, not the gambler. You're not hoping to hit a jackpot. You're running a system the same day, thousands of times over the month. It's not about betting right once. It's about consistent returns over time. 2, position sizing. People think that the trade itself is risky, but in reality, it's almost always the sizing that creates the problem with risk. Trade size should be small and controlled, often less than 1% of your capital at risk each day. It's planned, contained, and part of the model. 3, diversification with different setups and timeframes. You don't run one setup to work in all conditions. You use multiple types of spreads and strategies across different market conditions so you're not exposed to a single point of failure. 4, no overnight risk with 0DT. Every trade starts and ends within the same trading day. That means no waking up and surprise from earning reports, overseas news, or market gaps that hit while you're sleeping. When you go to bed, you know exactly where your cash balance is and what it will be when you wake up. 5, uncorrelated. And because 0DT expires by the end of day, this means that 80% of the week, your money is sitting in cash outside of market hours, which means it's guaranteed to be uncorrelated to the rest of the market. Each day you place a trade, you know the landscape of that trade for that day, and you know where you stand at the end of the day. When you combine those 4 levers, you're not just trading, you're building income designed to protect the downside first. Now, let's talk about Shannon's Demon. This is one tool I use most that investors have almost never heard of. Shannon's Demon. The name sounds intimidating, but in reality, it's just the principle of rebalancing in a way to turn volatility from a threat into fuel. Here's the idea. You keep 2 buckets. One is more volatile, high return assets. One is more stable, less risk, less return assets. When the volatile bucket jumps, you skim off the top and move it into the more stable bucket. When it drops, you move some of the cash from the stable bucket back into the volatile one at a cheaper price. By doing this consistently, you actually grow your wealth from the swings itself. Even if neither bucket has spectacular returns on average, most investors fear volatility because it makes their accounts yo-yo. Shannon Demon shows you how to harvest those swings into steady, consistent growth. When combined together with daily income engines like 0DT options, it adds another label of stability. The option strategy provides cash flow. The rebalancing provides compounding effect from volatility. It's not wishful thinking. It's rules, math, and discipline. And it's one of the ways to keep focus on what it should be, protecting the downside while still maintaining forward returns. Let's think about your nest egg and why doing it yourself doesn't necessarily work. If you're 5 to 10 years away from retirement, this isn't about, can I learn a new trick? It's about, should this capital be a training ground? For most people, the answer is no. Everything I've walked you through, the daily structure, the risk controls, the rebalancing, it all works perfectly together when you're able to do it correctly. Protect what you've built while generating steady income. But here's the truth most people don't want to hear. Most investors shouldn't try to run this on their own. And I say that as someone who did it, to try to do it on their own first. Before I ran a hedge fund, I was sitting at my kitchen table for 60 hours a week, laptop open, trying to piece together from YouTube videos and message boards. I've had a good week, then give it all back the next week or even the next day. Not because the strategy didn't work, because I didn't yet have a system, the discipline or the data to run it correctly at scale. This kind of trading is not a side project. It's not something you check between meetings. It takes structure. It takes a tested playbook for different market conditions, and it takes the discipline to follow through every single day, no matter what the market's doing. And the stakes are higher now. If you're 5 or 10 years away from retirement, you're not just risking a trade, you're risking your nest egg, the thing you worked decades to build. I see too many people willing to risk with what they need in hopes of making what they don't need. That's backwards. The smarter play is to take the portfolio you've already built and give it as part of the job. Let's get consistent income, reduce the pressure on the rest of your investment, and let it be the counterweight that keeps your entire plan in track, even in rough market conditions. That's what I do for others, so they can be more conservative everywhere else. So they can sleep at night and they can stop worrying about what if and focus on living their lives and going to their job and spending time with family. At this stage, the question isn't, how much more upside can I chase? It's how do I protect what I've built and turn it into reliable income? The old just ride it out playbook wasn't written for people that are 55 and have a sequence risk of returns in the market. The smarter shift is this: exposure to income from hoping the market pays you someday to designing cash flow with clear rules. For me and my clients, income is the outcome. If this resonates with you, let's talk. I can walk you through our approach. You can book a call in the description below. Protecting and converting what you've earned matters more than ever.